When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron. Hello and welcome to Moving Iron Podcast. Marcus with Shawn Hackett. Shawn Hackett is Hackett with his blah blah blah. Wow, that really came out well. Start over here. Hello and welcome to Moving Iron Podcast. Marcus with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's happening in the marketplace. So, Shawn, how you doing, bud?
I am really good, Casey. Super duper here in wonderful Greeley, Colorado.
Greeley, Colorado. Well, good thing there's not much agriculture in that part of the world.
No, it's definitely, all buildings and concrete.
So. Very much so, yeah. I think Weld County, Colorado is it's like the second or third largest ag producing county in the country, maybe. If not,
as you can tell behind me, agriculture is not important here at all.
Not at all. Not at all.
No,
are those dogs back there?
I think they're cats. I'm not
German
really sure.
Shepherds. There you go.
German Shepherds.
Now, well, there's a lot of dairy down that part of the world, a lot of cattle production and feedlot operations, those kind of things. There's a lot of row crop production, mostly going into silage formation for all the dairies and stuff that's there. So huge county as far as agriculture goes, also a huge county as far as energy goes too. So it's a pretty diverse part of the world that is very rich in what we're talking about here. So since you're getting ready to talk a little dairy to the folks out there today, let's start with the dairy side of the equation here. And you're looking out there, and that's just been, it just can't get a foothold. You'll see it take off and run and make a run for a minute, and then it'll just give it all back plus some. Obviously waiting on the Chinese demand that we need to see happen in dairy to get that price up. But Shawn, looking at dairy right now, what are your thoughts there, and where do you see that headed?
One of the interesting things is we always follow the relative value of any market to the Goldman Sachs commodity index or other indexes to see if they're outperforming, underperforming, or acting similarly. What's very interesting is that the dairy price for the last 2 years has literally been one-to-one correlation with the Goldman Sachs commodity index. It's unbelievable. It's just all you've needed to do to predict the milk price is just get the Goldman Sachs commodity price correct. So we have a market that's really being driven by the macro picture. What that's telling me is that right now milk prices are strictly being driven by what's driving asset markets, because it's being moved up and down by the overall commodity complex. So that's interesting, right? So what I'm going to be talking about today is right now, based upon its behavior, milk prices are going to turn up when the Goldman Sachs commodity index turns up. So that's one thing. The second thing is that when you look at the price of milk relative to cattle, relative to corn, relative to bean meal, all three measures are showing that milk prices are substantially undervalued. The last time, Casey, that we had this trifecta of undervaluation was August of 2021. In fact, I was here doing a dairy conference speech that month and went over the same criteria, suggesting that, we were pretty close, or, this should be a low area for quite some time. And that was obviously what began the run up to 25, 26. I think I'm trying to remember exactly where the price was at that time, but it was, I think it was 15 or something like that. So just because something is cheap doesn't mean it can't stay cheap, but understand that bottoms are made when a market is cheap. So I'm pretty comfortable that the dairy. And remember, we have peak production here in the United States, max supply right now in the United States. I just feel like this period. Now heading into June, it's probably going to be going to be a period we can look back and say that was an important low for dairy. Well, if I look a little further down the line, right? We know African swine fever at the moment is depressing protein prices in China everywhere, whether it's chicken price, whether it's the pork price, and of course, milk powder, which is a protein source, gets hit with that as well. At the same time, later on in the year, we know we've been through this cycle. There's going to be a huge shortage of meat proteins and proteins, or which means the demand for milk powder as a substitute or as an additive is going to be very, very high. So we like the demand side picture when we get further out into the year. Also, if there's a way to look at global liquidity, meaning looking at global central banks, global government spending, interest rates, and there's a it's called the GMI Financial Conditions Index, and it has tended to lead asset markets up and down, or telling you when liquidity is going to improve, not today, but like 6 months later. And so there's a lag. So it starts to go up, and then the asset markets follow behind it, and conversely, it does the same thing to the upside. That index turned up very strongly 3 months ago. And we've seen this. That means that the anticipation is that later in the year, we're going to see a significant improvement in liquidity globally, which means we're going to see probably interest rates come down, money printing starting again. We're going to see the economy improving, government spending, all these kind of things that tend to increase liquidity in the global banking system. And so once again, that suggests to me that later on in the year, the tight financial conditions that are creating consternation with asset markets and demand right now are the story 6 months from now is going to be how much the economy is on the mend. It's improving, things are getting better. And I think that's something that obviously the dairy market's very, very sensitive to that, because the restaurant side of the business drives a lot of cheese demand, drives a lot of butter demand. And so milk prices tends to be very sensitive to that future liquidity factor, that on top of what might be going on with African swine fever shortages and protein in China. I just feel, that we're in a good place in the milk market, meaning not today, like these are great prices, but I think we're in a good place that most of the downside, most of the negativity, is priced in. When I look at a chart at deferred prices, I think right now the average class 4, class 3 price from September through December is about $18.80 per hundredweight. I think that's what the average is right now. I think we might come down just one more notch down into June. This debt ceiling could create a little issue. As much as it in the end doesn't mean anything, the markets can react. So we might get one more knockdown in commodity prices. But I think $18, give or take, is probably your strong support area for the deferred price, which means we're pretty close. So I'm pretty. If I'm a buyer of milk in my business, if I'm DFA, if I'm a buyer of milk, physical milk, I think this is a place, I'd want to be protecting upside price risk right now. I think we're in a pretty good place with the dairy market for a important low and an improvement in prices as we move into the latter part of the year.
Right on. Okay. That's probably the best news that anyone's heard about dairy for a while there, Shawn. So it looks like there's definitely
it's been a tough 6 months. Some of the margins out west are worse than they were in 2009, which is really unfortunate. Yeah, it's rough. So
coming from a forage harvester perspective, the dairy price really drives that business. And those forage harvesters, when the dairy price is down, it's a struggle to get rid of stuff, or you need a drought, one of the two, and make the thing happen. So unfortunately, we're in that spot right now, and we're struggling through that. But kind of like we said, it does seem like you've seen the volatility where you're seeing these big spike ups and spike downs, spike up. That volatility is just looking for for a breakup or a breakdown, I guess. But
I think one of the biggest, probably the most important driver here for me is that the cattle price is so high relative to the milk price, and we have such a shortage of cattle in the U.S. It's not going to go away anytime soon. We can add some weights. We can mess around with demand a little bit, but we know that's just, the heifers aren't there. The cull cow rates are sky high in dairy. We're just not going to be able to grow the herd. In fact, we're going to shrink this herd in the U.S. pretty significantly as we get into the end of the year. And throughout history, that tends to be one of the most powerful, fundamental, long-term forces that drive supply up and down and drive prices up and down. And so we could have a perfect situation where you have the dairy herd really falling off, production really falling off later in the year, just as the U.S. economy is improving, the global economy is improving, and China wants every protein it can get its hands on. You could have for every action, there's an equal and opposite reaction. This has been a pretty negative reaction, but there's a possibility that later this year, the storyline could be diametrically completely opposite of what we're seeing today. And that's not unusual for dairy. Dairy is a boom bust cycle market, always has been, always will be. Whenever you have product that you really can't store for very long, if you just have enough, you have too much. If you just don't have enough, you don't have enough. So it's feast or famine. But I'm pretty optimistic, I guess, that those foresters are going to start, being bid up again later this year. So
right on. Okay. All right, Shawn, let's jump over and talk a little bit about cotton. So cotton, here we are. You hear the word recession every time something comes on, and we're headed for a recession. And we've been headed for a recession for, it feels like, about a year and a half now. And no one can say that we have the indicators. People are pointing out different indicators, but it really seems like no one really knows what's happening out there. So I guess, Shawn, as you take a look at the cotton market, how it's reacted since, we had looks like they put a low in sometime towards the latter part of April, around 77 cents. And now today we're trading about 85 cents. Still good price for cotton out there right now. If you're looking at where it is considerably where it needs to be at as far as profitability and those kind of things go. We go back a year ago, you start looking at where cotton was at there. Back in November, put a low in about 75 cents, and it kind of bounced back and teetered back and forth. But for the most part, cotton has kind of hung around that low to mid 80s on average here since about November of last year. So I guess, Shawn, as you're looking at the cotton market, what are some of your thoughts there, and where do you see that headed at?
The most economically sensitive ag market in the world is the cotton market. So we know, we just talked about this with dairy, cotton is even more sensitive to this liquidity factor, the economic factor. In most ag markets, it's supply and demand.
Right.
In the cotton market, it's supply and demand. Like, demand is extremely important in that market. Well, you can't get any more negative, in my opinion, about the global economy. I mean,
right.
Shoot. I mean, jumping off a 10-story building has been a pretty good option if you've listened to everybody talking about the cotton market and how demand's never going to return. So you have to believe that anyone who's wanted to have sold cotton because of the economy has done so already, whether physical or speculative. So I'm pretty comfortable that we have nowhere to go but up on the demand side of the equation. We also know that the acres that we're planting right now in the U.S. is going to be on the low side. Now, we don't know how much abandonment we're going to have. Texas can be a huge swing factor. Millions of acres can go unharvested or harvested, depending upon exactly how the weather plays out. But in the end, the amount of acres that we're planting is not high, which means even if we have good weather and a good crop, production's not going to be overburdensome if we have any improvement in demand whatsoever. And so I think the cotton market is sort of where it needs to be, right? I mean, if you looked at a price chart of cotton, it's been doing almost nothing for like 2 months. Like, it's been stuck in this 78 to 80 cent, just back and forth. It seems like it's at the correct price level right now that's matching poor demand with potentially, low supply. And it's sort of, to me, it feels like it's coiling. It's kind of like it's waiting for this demand signal to get triggered, and we could see a move to the upside later on in this year. Usually when markets get this quiet and low volatile and just I call it the EKG of a rock. It just is just doing nothing. They always say never short a quiet market, because usually when it wakes up typically to the upside. I think there's higher prices in cotton. It's not my favorite market, in terms of things I'm looking at, because I don't think the weather is going to be. I think the weather overall for the U.S. cotton areas is going to be okay, and I get more excited when weather might be adverse in a particular ag market that I'm interested in. But at the same time, I think the market can work higher based upon economic improvement and increased demand. And of course, we can always throw in some weather problems during the growing season. It's somewhere, there can always be an issue. But I like the market. I think if I'm a physical buyer of cotton, if I'm someone that's on that side of the equation and looking at how the price is playing out, I definitely would want to make sure I don't get caught, with a surprise spike trade higher on some news that demand is really starting to pick up somewhere. I just think we want to make sure I protected my physical supply to the upside here going into the end of the year from here. So
right on. Okay. All right. Last, let's talk about the hog market. And there's the market that just cannot get anything going. It'll have a couple of days where it runs up and does good, and it might gain 80 cents in a day, and then tomorrow it gives back $1.60. So I mean, it's just a huge amount of just turn on hog market right now. And obviously we're looking at what we see happening there with China and African swine fever, and you would think that there'd be more demand and more export demand for hogs than what we see, but China's made it pretty clear that they're only going to come to the U.S. when there's nothing else to get anywhere else. So you're seeing that kind of play out right now a little bit when you look into that. Also, the pork cutout side of this that was relatively high, that has started to kind of erode down a little bit as well. So looking at the hog market, Shawn, what are some of your thoughts there?
Well, I mean, no question that the U.S. demand for pork has been terrible. I mean, the pork cutout has just crashed. It's still near the lows. It's just been awful. And, one has to wonder why U.S. consumers aren't taking advantage of this tremendous value of pork price relative to the beef price. It's just amazing that, a lot of the people in the industry talk about how the industry is focused more on efficiency than flavor, and that they've lost sight that, people will pay considerably more if there's flavor, and that maybe the industry needs to get back to producing a more flavorful pork cutout than they have. The ruling by the Supreme Court that is allowing California to impose restrictions on where the pork, that the pork can only come into California if the pigs are treated in the manner with which they feel they should be. There's a whole list of how they believe they're supposed to be handled in a more humane way, but the Supreme Court upheld that they have the right to do that. And so there's a ton of pork that's not going to California that would normally go to California that needs to go somewhere else short term. That's also it's not good for the U.S. pork price, because now you have to find a new buyer for this pork at a time that we already are struggling to find demand for the pork to begin with, at a time that African swine fever is terribly depressing pork prices in China, and the hog price in China is extremely depressed. So this is a tough time, Casey. Obviously, they always say the best way to cure low prices is with low prices, because eventually, if you have low prices for long enough, demand will come and take that value off the market. But this is going to take a little while, Casey. I think, given this decision, and the problem with it's not that the hog producers can't do what California is asking of them, but it's going to increase their costs, and they want to know: are you going to pay the higher price if we do this to offset our cost? Yeah. And no one is giving them any assurance. No one is saying, yeah, we're definitely saying, oh, it'll be there. Well, you know what? Show me, show me that you're willing to pay a price that makes it worth my while to go do all these things you're asking me to do and increase my costs. The hog producer is not going to do it right now, in mass. And so that's right now. And that's not a good situation. as we move through the next couple of months. However, African swine fever, as we said earlier about dairy, will lead to a serious shortage later in the year. Demand from China will pick up later in the year. We at these prices, we just like in dairy, we're looking at some of the greatest losses in the hog industry since 2009 in terms of net margins to them. I mean, you cannot run the industry that way for very long and think that you're going to continue to. So weights are going to come down, Casey, and the hog herd is going to contract. No question about it. So what you're going to be looking at later this year is you're going to be looking at a reduced hog herd, reduced weights, reduced supply, and I would have to believe that as the U.S. economy improves, we're going to see some better demand for the pork price. So tough sledding right now. It's unfortunate that the decision was made from the Supreme Court to limit pork into California at a time that things were already very, very bad for the hog producer. Can't control that. It probably kicks the can down the road for maybe another month or two for lower prices than would have otherwise been the case. But I do think that if you're looking at December hog prices here, I think around this low 70-cent a pound area, if you look at the charts, that looks like a pretty good area for this market to start developing some kind of a bottoming process, like we talked about with the cotton market, where it's just starts to develop some kind of a sideways trade. So I think most of this negative news is now in the hog price, but I'm not certain that we're ready to turn the market around anytime soon. I think we need a couple of months of base building before we get there. So
okay. Good stuff as usual, Shawn. Folks want to reach out to you and get more information about what it is you're doing over at Hackett Financial. What's the best way to do that?
Well, we have a Twitter page, Faradex11, at Faradex11, that people can go to. We have a LinkedIn page, and we also have, of course, have our website at Hackett, HACKETT, advisors.com. We typically post interviews from time to time to go over some of our capital flows, weather work, and forecasts, and what we see going ahead and how we go about making those recommendations.
Right on, man. Shawn, I appreciate you being on the podcast.
Thank you, Casey. Appreciate it.
Safe travels back from Greeley, Colorado, back to the warm sands of Florida.
Back to Mercury. That's where I'm heading, back to Mercury. So summer's arrived.
Summer has arrived in Florida, huh?
It's hotter than hell now.
Yeah.
Of course, I'm not complaining because I like it hot, but it's hot now. Hot.
Yeah, well, you'll have your opportunity to like it hot. I have that in my head there, because I've been.
That's where you take your wet clothes and you put them out to dry, and 6 hours later they're just as wet.
Just as wet as they were. Get that machete out and cut your hole through so you can walk around, right? So yeah,
that's right.
Stuff. Well, Shawn, thanks, man. Have safe travels. We'll talk to you on Thursday.
Sounds good, Casey. Thanks.
All right. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Check us out over on the YouTube channel where you can watch the video version of this and see the cool artwork behind Shawn here. So check that out. Go to the YouTube channel, which is the Moving Iron Podcast. Then go to MovingIronLLC.com for everything Moving Iron related and get all the information for the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. If you're interested in getting more information about that, send me an email at MovingIronPodcast at MovingIronPodcast.com, or you can just go ahead and sign up right there on the website. So with that, I'm Casey Seymour with Shawn Hackett. Smooth Smart folks out.
Moving iron in the 21st century.